Hi guys, and welcome to another week of State of the Market. As you all know, I am Mike Fattori, joined by my lovely co-host Jennifer Budol, and this week we again have another jam-packed episode on the latest findings across Melbourne and the build-to-rent sector here in the country.
Yeah, so guys, the number of construction build-to-rent units is set to double each year to 2025 as developers, backed by institutional investors, swoop on widening opportunities in the sector. According to Kerman and Wakefield, the number of build-to-rent units will rise from 1,800 in 2022 to nearly 16,000 by 2027, based on existing projects alone. The now $9.6 billion sector was given a boost in 2020 by specifically targeted land tax reductions in New South Wales and Victoria.
Fantastic. So since then, guys, 14 major institutional investors have rolled out plans for 40 build-to-rent projects across the country, representing 12,800 units and a combined value of circa $9.6 billion in projects under construction. Cushman & Wakefield Head of Metropolitan Markets Lucas Burns said the nascent build-to-rent in Australia had reached a turning point and would likely play a key role in absorbing fundamental housing issues. Population growth, supporting tenant demand, higher rents increasing investor returns, and a significant amount of capital targeting Australian housing are all tailwinds for build-to-rent over the next decade. Australia's population growth will support demand for at least another 300,000 rental units by 2029, which will positively impact the build-to-rent market.
Awesome. So in other news, the City of Melbourne is forecasting an underlying deficit of $36.9 million attributed to the long-lasting impacts of COVID outbreaks on the economy of the city, and therefore will sell off 4 properties of its city council as they grapple with a $19.5 million hole in its budget at the end of the third quarter. Labour shortages and supply chain issues, along with a $22.8 million shortfall in parking revenue driven by COVID-19 restrictions, are biting into the City Capital Works program as they underspent against its budgeted project, with a report indicating 10% of capital works were now off the track.
So guys, at a council meeting this week, a plan to divest 4 disused community assets was endorsed. The plan will now go to public consultation in July as of this year. The properties slated for sale are 47 to 49 Canning Street at Carlton, 100 to 104A Beckett Street in Melbourne, 30 to 38 Gatehouse Drive at Kensington, and 505 to 513 Abbotsford Street in North Melbourne. The City of Melbourne announced a record $254 million infrastructure spend in its draft budget for 22-23, including $40 million for its landmark greenline development along the edge of the Yarra. The massive infrastructure pipeline will generate up to 1,000 jobs, providing a significant economic boost for businesses across the city.
If you'd like to know more about how we can help you on your investment journey through real estate, please get in touch with either Mark or myself to directly assist you with your goals and provide you with a better understanding of the future ahead in real estate. Until next time, guys, enjoy.